How you doing? It's Drew Blazik here, Logos and Markets. In this video, we're going to talk about option strategies. We're not going to just go in depth about what a put and a call is, but we want to understand how do you use a put and a call through a model. So we're going to use an Excel sheet. We're going to use our sim method. So I'm going to pull this up, just kind of, just a reminder, make sure you put your name, and then you're going to put your email address. Just kind of split it up. And then once you do that, if it runs perfectly, you must see the OK symbol on the bottom. If you don't see it, it's not going to work. Make sure you do that, or your grade will not show up. And then it'll say valid macros ran, and then the questions will pop up. So here's all the equations here. So I wanted to go through this really quick. This is not an introduction video to puts and calls. This is really just for this model that you got to make sure you understand the concepts of it before you do this. And I'll just briefly explain it. So a put is a right to sell. That means I could sell it for a certain price. The price that it could sell for is called the strike price. And we'll do this a million times in this model, so you'll get the hang of it. The stock price can move all over, right? We don't know. Right now, we're going to say it's at $100, and I could sell it for a certain price. Well, there's a buyer of the contract, and there's a seller of the contract. Very important. The buyer and the seller will have a certain profit. Typically, it's the strike price and the stock price. We have to figure out which one's which for the buyer and the seller. And then you got a call, which is a right to buy. A right to buy. And again, you got a buyer and a seller for the contract. However, it's a strike price. You have a right to buy it for a certain price for a specified time. So if the stock price goes up, let's say it's for a year, to 200 and it's 100, I could buy it for a right to buy for whatever the contract says, let's say 110. That's the strike price. So if it goes up, right, to 200, if I bought the contract, well, I made 200 minus the strike price, and the seller has to make up the difference. So they're the opposite, strike minus stock. And then you also have something called a premium. For me to have an option in this contract, I have to pay the contract. So and we're going to do it. I don't have to explain it right now, and we'll see exactly how it works. These are the equations to use for our model. You want to get to the point. You're not memorizing it. You understand it. In this video, I'm going to do a few examples, but you have to do the rest. This is more advanced. Some of my courses, I will not have this part of the grade, and I'll show you how the grade is separated. But we have to find net credit, net debit. We have to find the width of the spread for some strategies to figure out our maximum loss. We want to find out what is the risk and reward of it. It's all based on volatility. We want to see if it's very volatile, how much money we're going to make. And then also we're going to have our expected range. We're going to talk about probability of a profit based on standard deviation. We're going to do all these calculations in it. But again, that's more advanced. That's the bottom of it. I'm probably not going to have most of my classes do that. But let's get into it. Let's talk about a call first. This is what our model will look like. This is the basic portion of it. I should have highlighted this gray to show you that we must enter in values. Anytime you see gray, that's what it means, and I must have forgot. All right, so this is what it's going to look like. So we want to say, okay, what is the current stock price? So we're just going to put $100. And what that did was the spot price is the current stock price. And our graph over here shows that's all the possibilities of the stock price, and this is our profit loss. It's not built yet because we have to enter in what do we want as continuous compounding. So this is more, it's a little different how we're going to say the stock range. What increments do we want the stock price to go up or down? So I'm going to say 5%. So based off that spot price, I hit 5%. And now you have a decline of negative and then you have a positive going up. And so what does that mean? That means the stock price range. And if you look at the equation, it's a continuous compound I did to the E function. So it's not just declining by a certain percent, it's for continuous compounding. All right, so I just want to show that the upside is 149, the downside is 67. And what we want to do is, okay, this is for a call. It's a right to buy. I could buy it for a certain price. Right now it's $100. And I'm going to say, well, it's a right to buy for 110. Okay, that means I could buy it for 110. I'm too nervous about buying this stock, right? It's too risky. Therefore, I want to pay a contract of $3. That's the premium. That's what it's costing me, that I could buy it for 110 at a certain time, and then it expires. How this works. All right, so let's look at the terminology here. We have a couple things here. We got something called a long call. That means you're buying the contract. This is called a short. That means you're selling the contract. Now we want to know the profit and loss for both, and we're going to see a graph that pops up for the profit and loss for the buyer and the seller. So let's get to it. All right, so we want to think this through. Would you exercise your contract if the stock price is 67? What does that mean? Would I want to buy it for 110 if it's only 67? No, you would not. You only want to buy it if the stock price goes above the 110, or at 110, you could say. So anytime for a call that it's below the strike price, that's out of the money. If it's at 110, that's at the money. And then it's above 110 for a call, that's in the money. Which means if it's in the money, the stock goes to 150, I can say, okay, I could buy it for 110. That's the contract for 110. If it never hits that, it expires. I walk away. I'm out 3 rather than losing money on the stock. So I want you to think about, what is the profit and loss for this? So I'm going to go equals. So first off, anytime you buy something, actually before we do it, let's just talk about it. The profit and loss, I want you to think about, if the dollar value goes up to 120, the stock price, well, how much did I make? I bought it for 110 and it went to 120. Therefore, it's going to be the stock, well, let's go down here to 122 to show. It's going to go 122, this is my profit, right? Minus what I paid, the strike price. Well, also, and a couple things. That's the strike price. I have to hit function F4 because I want to freeze that. So then when I drag it up or down, I don't want the stock price to move. The strike price to move. The only thing I want to move, different levels of price. And then also it's going to cost me something, right? I bought the contract. So I need to subtract out the premium. I'm going to hit function F4. So that's the profit loss for the buyer, okay? So if I go all the way down, I just want to show how this works here. Well, everything looks good, but look what happens. Well, what I'm going to do is I'm going to hit Control C. I'm going to copy it, and I'm just going to hit Alt ES F, and I'm going to Alt ES special formatting. I'm just going to format the the formulas. Well, if you notice what happened, there's an error that happened. It's because this function we created, well, it works if it's in the money. If it's out of the money, you would let it expire. It doesn't make sense. You would lose money. You would lose more than the premium if you bought it at 110 and the stock was 105, right? So this function is not adequate enough for what we want. So let's go, I'm just going to that $29. I want you to think about what this means here. Is we need to do, when you purchase it, a max function. And the reason is, I want the difference between the stock minus the strike if it's making me money. If I'm losing money, I'm going to walk away with 0. So if this value is negative, I don't want that. So I'm going to hit comma and I'm going to hit a 0. So if this is negative, I'm taking 0. If this is positive, I'm taking this. So a max function is perfect because, okay, I forgot to do one thing here, is the max function does not include the premium. So what I need to do is go into that stock minus strike, hit the 0, and then close up the max function. All right, so let me explain further, is that if it's negative, it's going to take whatever's greater, the 0 or a negative number, so it takes 0. If we make a profit on it, it's going to take the higher value, right? It's going to take a profit, a positive, or 0. So a max function will work. So I'm going to go there. I'm going to copy that and hit Alt ESF. Well, all right, let's say our call graph did not look good. So this is the profit and loss for the buyer of the contract. Let's look at the call option here, right? If it's out of the money, look what's going on. We lose money. We just lose the premium of the contract. Right where it hits right there, that's right around 110. Now you see it going up. That means every dollar the stock goes above $1, I'm sorry, of 110. So imagine what's my break? What's my profit loss? If the stock hits 111, I buy it for 110. I make $1. I have a premium of 3. I lost $2. If the stock price goes up to 112, I made $2 on the stock. Right, buy it for 110. I paid 3. I'm down -1. And then if it hits 113, right, the break even. What stock price would I break even is 113. So right there is right about 113. And then if it's 114, I made $1. 115, I made $2. 116, I made $3, right? And it goes up from there. So this is what the buyer's profit and loss looks like for the contract here. All right, now let's think about, and I'm going to go into the loss here to show how this works. Let's think about the seller. What does the seller gain out of it? Well, if the buyer is, the seller has to, if the buyer's making something, the seller's got to pay it to them. So the $3 that the buyer paid for the contract went to the seller. If the buyer benefits, the seller's got to make up that money. So if we look at it this way, let's go, I guess it'll make more sense down here. Well, the seller must make up that to pay the buyer. So it's going to be inverted. So the seller is going to be, well, it's the strike price, right? If the buyer's the stock price minus the strike, the seller must be the strike price. I'm at function F4, keep that frozen, minus the stock, right? They got to pay that. Look at that. They got to pay that difference. Well, it almost looks good. Plus, they make a premium of $3. So the contract was paid to the seller of 3. So the buyer was paid 15 and the seller, so it's inverted. It's always inverted with these two, the buyer and the seller. The money doesn't come out of nowhere. The seller has to pay the buyer. The buyer's got to sell the premium to the seller. So you can see how that works. So if I copy this, and let's just do here. So far it makes total sense. Inverted. Every dollar the buyer makes money, the seller receives, or I'm sorry, has to pay the money to the buyer. So you see how it's inverted there. However, if I drag this equation up, that's not going to work. It doesn't look right. If you ever do that, this is a good lesson. If you ever accidentally do that, hit Control Z or the grading will not work. Okay, so this isn't working right with those numbers. We got to think about why. Is because if we are if there's no money to be made on the contract, the seller doesn't make any money because the buyer is the buyer can exercise the contract. The seller just watches. Therefore, the seller can't make a profit more than the premium, right? if the buyer's not making money on the contract, he lets it expire. Therefore, that wouldn't work. So what function would we use? So I'm going to get into the seller here. So anytime there's a seller, it's a minimum function. And what does that minimum mean? Is I'm going to take whatever is less. I have to make that difference to the buyer. So that's going to be a negative dollars, and I'm going to hit comma or zero, because I can't make a profit on it because the buyer will never exercise it. He will never take the loss. So if there's a gain to be made, I want this function. I don't want it to show a positive value. I want it to show whatever is less, that or zero. So that's what we want to do. So it's a minimum function. And then what we're doing is we're saying outside of the function, we're saying plus you always get that premium. So if there's money to be made, let's say it's 50 bucks, I'm going to take zero for the seller all the time because the buyer never exercised it, right? He just let it expire. So that's going to be the perfect equation that we need. So I'm going to copy that. I'm going to have it go all the way up here. Hit Alt ESF. Let's copy that in. See, the most the seller can make is $3, and the minimum function gives us that ability. All right, there's the call option. As you can see, that's the seller, the orange, shorting. That means he makes a profit, makes a profit, makes a profit. The break even is at the same point, 113, right? The seller's up 3. Once it hits 113, the buyer exercised it at 110. Therefore, he had to pay 3 to the buyer for the stock, plus he received 3 for the contract. So break even is 113 for both. So that's what it looks like for the call. All right, let's do the put. A put is a right to sell. It means I could sell it for a certain price. So let's plug these values in. We'll say it's 100. Strike price, that means we could actually sell for 90. Let's do a premium of 5. And let's do the same thing, increments of 5%. If you wanted a larger range, you can do 7. You can do whatever you wanted. And just so you know, it's continuous compounding, so it's going to look more linear. And just kind of briefly talk about the reason why is we're not just going dollar values increased by 10. If the stock price goes up by 10 bucks and it goes up by a certain percentage, well, the more the stock goes up, the percentage becomes greater and greater because of the stock price. So that would be more accurate in that terms. As the stock price declines by 10% each time, well, the dollar value of the stock is declining. Therefore, the 10% gets smaller and smaller. All right, so we got that. We want to look at, here's our range based off 5%. That's purchase. That's a sell. So let's look at the perspective of the buyer, and then we'll put in our function and see if we do this correctly. So what this is saying is, here's the stock price, right? This is what we at the spot rate. This is what happened. Now it's at 82. So what is the profit and loss to the buyer of the contract? Well, they could sell it for 90. I'm at function F4. Oh, I don't mean to do that. They could sell it for 90 minus the stock price, the current stock price that's going on at that moment. So if the price goes down to 50 and I can sell for 90, I made 40 bucks. If the stock price goes bankrupt and I can sell for 90, I made 90 bucks. So it's always going to be the strike minus the stock. That's going to be the profit for the buyer of the contract. And we also have to include minus, we had to pay that pesky premium, right? We had to pay that premium. I'm going to hit function F4. Any of those values up there, make sure you hit function F4 so we can copy that formula. So that looks good. So as I drag this down, it didn't work right? Because why would you sell? And I'll think about it. If you have a right to sell it for 90, why would you sell it for 90 when the stock is at 110 or 111, 122? Why would you sell it for 90? So you're not going to exercise it unless the stock drops. You're predicting it's going to fall. So you're going to wait for it to fall, but you're not going to purchase it, or I'm sorry, you're not going to sell it unless it drops below the strike price. So what, you notice how that's a negative? Let's open that up. That means I'm only going to exercise it if there's a positive profit for the buyer. Therefore, what are we going to do? We're going to do a max function again. I'm going to do that function right there. So I'm going to say that's the profit and loss, strike minus stock, and then I'm going to hit comma. Well, if it's a negative, I want whatever is greater. Is the profit for myself or 0? I'm going to take 0 if nothing happens. And also I have to subtract out the premium. So that works. So I'm going to copy that. And those who know that you can drag that down a little easier than what I'm doing. I hate when my formatting is messed up. If I dragged it down, it destroys my borders. Don't worry about on your end. You're not going to be graded on that. You could drag it down. But if you do special pasting, that enables the formatting to stay the same. And only thing that's inputted in there is the formula. Now let's look at the perception of the seller. We saw the buyer has a profit on a put, right? Strike minus stock because we have a right to sell. Well, let's look at, and again, just like the call, it's going to mirror it. So let's go up here. Let's look at the seller, and we'll build a function here. Well, the seller is strike minus stock. That means the buyer. The seller must give the money to the buyer then. That means they're going to be the stock price minus the strike price. And then what they receive is they receive a premium of $5. So that's the profit loss for the seller. So if I copy that, I'm going to just show what it looks like. Well, that looks good up to that point is because, well, at this point the buyer is losing money and they're not going to exercise it. Why would the buyer sell it for 90 when the stock price is say 150, 135? They're not going to do it. They're just going to let it expire. They would sell it for 135. They wouldn't sell it for the 90. Therefore, we have to adjust our function. And remember, when we talk about a put, it is a minimum function because I take whatever is less. I'm going to take that profit or loss. So that's a negative because I got to pay the buyer. Or if there is profit to be made, well, the buyer's not going to accept it, will not exercise it. So I'm going to take a minimum function, whatever's less between the stock price minus the strike price, or 0. And then plus you have your premium. So this should show what it's going to look like. Again, the call or the put. The put is for people that are bearish on the market or on certain stocks. You think it's going to drop. You're hedging against protection for whatever reason. Okay. We could kind of think about what's the break-even point. Well, the break-even point must be 85. That's where the break evens, because if the stock price is 90, you can sell it for 90, but once it hits 85, the buyer makes the money back of the 5, and the seller loses the 5 at 85 because they have to make it the difference between the stock and the strike. So the break even is at 85. Okay, the rest of it, I'm just going to show you guys something. You got the covered call, long strangle. We got short strangle, long straddle, short straddle, long butterfly, which I already solved. I got to delete it. Short butterfly, bull spread, bear spread, long condor, short condor. And I'm going to show you the grade real quick. Is you got two things here. We got 100%. That's the grade there. That's what this assignment's going to be about. Also on this Excel sheet, I'll have to create a different video to show this. These are the advanced calculations for our model. I'm not going to expect you to do it unless you're in an upper level course. I may have you do it. But those are expected bear profit, expected a possibility of profit, expected loss. So those are all the values that are very advanced, and we could check on the probability of what we believe is going to happen based on the volatility. So I'm going to do a couple of these, and I'm going to show you there's a little more work to do it. And again, you don't have to complete the bottom part unless I require it separate video. So let's go to a protective put. There's a little more involved. All strategies are to the right. It'll explain everything. So let me explain a few things. Is that just remember, I think a butterfly has this, maybe a bull spread. So you got to be very cautious. And when we do it, is that in the money, out of the money. That means if it's let's say it's a put. If it's in the money, you got to put the strike price in the money. So if it's $100, if it's in the money, it's got to be for a put. It's got to be 105, 103. A call in the money would be at 95 if the stock price is 100. So that's what it means. ITM's in the money, out of the money, which is what we did with the put and the call. So based off those strategies, you're going to plug these values in and you're going to figure out the rest. So let's just I'm going to show you an example. And then it shows upside, downside. You can read about it, which is super cool, by the way. Okay, let's do this one. We'll do a stock price of $100. We got a strike price. What is this? Protective put. What's a protective put? Protective put is where you buy the stock and buy the put. That's a protective put. And we'll see exactly how this works. So we have a strike price. We'll just do the example out of the money, right? This is out of the money. Stock price 100, strike price is at 90. We'll do a premium of 5. And we'll do the same thing, increments of 5%. All right. So let's do this, and then I'm going to do this, and then I'm going to do all this stuff here. Once you get the hang of it, it's the same with all these strategies. That's all. This will constitute that part of the grade. You have to complete that. You do not have to complete the advanced unless I say otherwise. All right, so we long the stock. And if you don't know what to do, you could read down here. It kind of tells you how to do it. We bought the stock. Well, let's think this through. What's the profit loss of the stock? The profit and loss is the current stock price, right? So if that changes up or down, minus the stock price that we paid. I'm going to hit function F4. And make sure this looks right. If I drag it down, okay, it makes sense. Stock goes to 105, I made $5. Stock goes to it's really 110.52. I made 10.52. So that makes sense. So it's going to be, this is all the different stock prices. It'll be this one minus the stock price, what you paid for. And that's up there. Function F4, freeze that. All right, so what I'm going to do is I'm going to hit Control C. Just so you know, protective put and a covered call are the only investments that has the actual asset in there. All the other strategies, strategies. All the other ones don't have a stock in it. It's all puts and calls. All the other strategies. This one has the actual stock, and you can see that we lose money if the stock goes down. We make money if the stock goes up. All right, next what we want to do is, okay, we purchase the put. Let's kind of go through kind of quick on this. We bought it. It's a max function. Well, what is it? It's the strike price minus function F4 minus that stock price. And we're going to drag that down. Well, I want whatever is greater, that or 0, because I'm not going to exercise it if it's negative. Minus, I had to pay that premium. Function F4. Control C. Hit Alt ESF. Look at that. Okay, next part, we want to know what the strategy, what's the payoff here? So the payoff is, that's my strat. If I bought the stock, that's my how much I make if the stock drops to 55. Plus, this is what I make on the put. So 15. Let's drag that down. You notice we're capped at 15. We're going to lose nothing more than 15. Let's go all the way down. Control D. Hey, I like to keep my formatting. I know it's a pain, but it looks good. So there's our profit loss. Let's go look at our beautiful graph. Where did I put it at? Right here. That's what a protective put looks like. It goes Now, I'd love to ask the question, hopefully you can say it. What does that look like, a protected put? It looks like a call. So you can say if we have the same asset, we have the same strike price. The question I want to ask, is it the same as doing a protected put, as instead of buying the stock, you hold on to your money and you have to discount that at the risk-free rate. If you hold on to your money and you buy a call, that's what it looks like, buying a call. So that's good stuff. Okay, next. Now this is the next part that I did not have early. This video is going a little longer than expected. So I'm going to go through this kind of quick and explain it, but this will be the same for all the strategies. Implied volatility, what is that? I'm saying we believe that standard deviation is 25%. Time to expiration, you could say a quarter of a year. I'm saying a year. You could say half a year. Now we need to adjust the volatility to multiplied times the square root of our years. And why does that work? If we do a half a year, that would show the volatility is really only 17.77. So that's how you find it. It's the volatility standard deviation multiplied times the square root of time. And then we want to know, what is the price standard deviation? Well, it's the standard adjusted for time multiplied times the stock price. That just says it can deviate positive or negative by 17.68. All right, so we want to know is, oh yeah, I forgot to do the strategy. So I want to compare what's the strategy, this compared to just buying the stock. So I just want to find the difference. So this is going to show us how much better off we are. Well, I'm going to show you. So if I drag it down, it didn't get rid of my border. I lied. The whole time I could have been dragging it down. I apologize. So I love this this one here. This is saying strategy compared to just buying the stock. So I found the difference between that. So if you just bought the stock and it went down, look, you're up 30. You make money, you're protecting, you're protective put, you're protecting yourself. However, if it goes up, the most you're out is the premium. That's what it shows. All right, next, what we're gonna do is something called, we wanna find out this is a normal distribution. I'm gonna find the density of it. This is not the probability yet. We're gonna find the density. So we're gonna say a normal distribution, type in equals normal. And then what it's gonna ask here is what is the, now you could do stock price, but ours is continuous compounding. So I'm gonna do the percent change. If it declined by negative 60%, we're going to say is what's the it's going to give us a number, and we're going to show how we can create a probability from it based off what's the chances, if the volatility is only 25%, what's the chances of losing 60? That's the question that it's going to answer for us. Next is what's the mean? If we did a dollar value, I would do the stock price at 100. But we're doing percent change. It declined by 60. That means the mean is going to be 0. At this, the spot price, there's no change, right? It's 0. No percent change. Comma. Next is what's the standard deviation? You must hit that for adjusted for time. And I forgot to do my function at force. I'm going to go to the formula bar up there. Oh, that's all we need. Function of 4 is the standard deviation is only one you need function for. Comma, next one we want to know, is it a cumulative distribution function or is it a probability mass function? We're doing a probability, so that's going to be a false. I'm going to hit enter. So it's going to give us, I see some value there. As you can see, as we're closer to what is actually going on, you see how the number is larger. So this is how we're going to figure out a probability. Is I'm going to go down here and I'm going to sum up the density, which is 19.99, That's the total. So it's very simple. To find the probability is I'm going to take the density and I'm going to divide it by the total. And that's going to give us the probability it's going to hit that area. Function F4, always remember that. I'm going to hit Control C, go all the way down, hit Alt E S F, hit formulas. There's our probability that it could happen. Always good to sum that up. 100%, well, I should say 100%, but 1 is fine. And then what we're going to do is, well, what's great about the probability based on this, well, you could argue, you know, that standard, that volatility is pretty big. Let's just do a 5% probability and see what happens there. It is not at a very low deviation. There's really not a chance it's going to drop below a certain price if we don't think there's much volatility with this stock. So next what we're going to do is we're just going to take the contribution, which is the probability of it happening, multiplied times the profit of it. So this is going to show our expected, so we could total this up. That's our expected profit based on this strategy. We're going to lose money. That's great. Why are we going to lose money? Is because the only way to make money, a protected put protects you if the stock drops. I put 5%. I put a 5% volatility, which means I don't think it's moving that much, which shows the numbers that there's not a really good shot of it going down, which means I'm probably just going to lose my premium, 4.9. Now let's change this. Let's go to 20%. Everything changes. See how the loss goes a little higher. Now let's do a larger. Let's say 30%. Let's see if we can get a profit in here. Now we're going to make money. And then really, I mean, are you expected to make money with the protected put? No. It protects you from downhill, a bearish market. All right, I think I've gone far enough here. So that is a completed protective put. And then what you have to do is, here's a covered call. Again, buy the stock, sell out of the money or, at the money or out of the money call. That's the strategy. Then you want to go a long strangle, and it'll tell you exactly what to do. Buy out of the money call, and then you buy out of the money put, and you combine them. There you go. You long the call, and if you don't know what to do, it shows it right there. And then you long the put. And then you could plug in all the numbers, and then you can do the calculation and find the expected profit and all that. So, hey, that's it. This video has gone way too long, but I'm probably going to do a part 2 for those who are going to do those advanced calculations. Just want to say God bless, and I'll see you later.